It is Monday night, January 19th, 2026. I need you to stop scrolling. I need you to mute the noise, because while the entire world has been laughing at President Trump's renewed attempt to buy Greenland, while CNN runs 24-hour coverage of Danish politicians acting offended, something catastrophic happened on Friday afternoon at exactly 4:47 p.m. Eastern Time. Nobody is talking about it. The algorithm is suppressing it, but the financial plumbing of the Western world just sprang a leak that cannot be plugged. I'm talking about a document, a boring, technical, 8-9-page geological survey quietly uploaded to the U.S. Geological Survey website. It looked like trash. It looked like bureaucracy. But buried on page 47 of that document is a single paragraph that just effectively murdered the global silver pricing mechanism. Before I break down exactly what is in that paragraph, and before I prove to you that the Greenland joke is actually a calculated geopolitical resource war, you need to understand one thing. The price on your screen is a lie. Spot silver closed at $93.67, but as of this morning, private commodity traders in the Arctic are paying $137 per ounce. That is a $43 premium. That is a 46% spread. That is not a market inefficiency. That is a crime scene. 3 weeks ago, we warned you about the Shanghai premium. 2 weeks ago, we showed you the COMEX registered inventory dropping below 60 million ounces. We called it all, and tonight, I am going to connect the dots between a frozen fjord in Greenland, a panic in Beijing, and the reason why your silver stack is about to become the most strategic asset on Earth. Welcome to the Arctic Silver War. Let's investigate. Here is what they are hiding from you. On Friday, January 17th, the USGS, in cooperation with Greenland's Ministry of Mineral Resources, published a revised assessment for the Citronen Fjord deposit in northern Greenland. Listen to these numbers carefully. This is official government data, not a rumor. The report states that updated core sample analysis indicates previously undetected silver concentrations averaging 847 grams per ton across an estimated 2.4 billion ton ore body. It goes on to state that this represents a potential in situ resource of approximately 2.03 billion troy ounces of silver. Let me put that into perspective for you. The total global mine production in 2025 was roughly 830 million ounces. This single deposit in Greenland contains enough silver to supply the entire human race for 2.5 years. It is 113 times larger than the Cannington mine in Australia. It is the largest silver deposit ever discovered in the Western Hemisphere. But here is where the story turns from a geological report into a financial thriller. Look at the timestamps. The drill cores were analyzed between June and October 2025. The assessment was finished in November. The U.S. government has sat on this data for 3 months. And when do they release it? The exact same week, President Trump announces a 10% tariff on European nations and renews the push to acquire Greenland. Do you believe in coincidences? Because I don't. This is a coordinated data drop. The Trump administration held this card up their sleeve to justify the purchase to the American public. To the average voter, Greenland is just ice. But when you show Congress 2 billion ounces of the most critical metal for 5G missile guidance systems and solar panels, suddenly, it isn't ego, it is national security. The price disconnect, the real squeeze. While the mainstream media focuses on politics, the physical market is screaming. I spent 3 hours yesterday on the phone with bullion dealers and logistics coordinators. The official spot price is $93.67, but try to buy an American Silver Eagle right now. You are paying $112. That is a 19% premium. But it gets worse. I have a contact in Arctic logistics, a guy who moves heavy machinery for mining operations in northern Canada and Norway. He confirmed yesterday that private trading desks are quoting physical silver for delivery to Arctic ports at $137 per ounce. Why would anyone pay $137 when the screen says $93? Because in the Arctic, silver is no longer a commodity. It is a strategic resource. If you are a defense contractor or a tech giant, you don't care about the COMEX price. You care about possession. You pay whatever it takes to lock up supply before the US or China draws a new iron curtain around the region. This is what we call bifurcation. The law of one price is dead. You have New York paper at $93. You have London physical at $108. You have Shanghai at $107. And now, you have the Arctic strategic price at $137. The market is fragmenting based on geopolitical access. And the COMEX, it is becoming a museum exhibit for a price that no longer exists in the real world. The geopolitical chessboard, US versus China. Now follow the money to Beijing. Within 24 hours of the USGS leak, the Chinese Ministry of Natural Resources held an emergency closed-door meeting with executives from Zijin Mining and the PLA's Strategic Support Force. The very next day, the Global Times runs an op-ed titled, "Arctic resources belong to humanity, not hegemons." That is diplomatic speak for, "We are coming." Sources at the Financial Times are already leaking that China is preparing a $300 billion infrastructure package for Denmark and Greenland, deep water ports, 6 gigabytes, fiber optics, airports. That is 100 times Greenland's GDP. The White House is panicking. The Wall Street Journal reports a U.S. counteroffer of $150 billion, plus military protection guarantees and a pathway to independence from Denmark. If the U.S. gets exclusive mineral rights for 50 years, Greenland is now the prettiest girl at the dance, and 2 nuclear superpowers are fighting over who gets to take her home. The structural deficit, the zone of death. Why this desperation? Because the math is undeniable. By 2030, global demand for silver hits 1.5 billion ounces due to the explosion in solar's 600 gigawatts year, EVs, and AI hardware. Global supply. It's capped at 1 billion. That is a 500 million ounce annual deficit. You cannot fill that hole by melting down grandma's silverware. You need new mines, and the only deposit on Earth large enough to move the needle is Citronen Fjord. If the US controls it, we starve Chinese solar manufacturers. If China controls it, they choke the US defense industry. This is why the price is vertical. The market realizes that whoever controls page 47 of that report controls the industrial future of the 2030s. So what happens next? We are looking at 3 scenarios for the next 30 days. Scenario 1. The US wins. Trump cuts a deal. Spot price might dip momentarily on new supply rumors, but physical prices stay high because that mine is 10 years away from production. The real shock hits China, sending Shanghai premiums to $140 as they scramble for scraps. Scenario 2. China wins. US industries panic, buy everything in sight. Physical silver in North America goes to $150 overnight as Tesla and Raytheon realize their supply chain is compromised. Scenario 3. Stalemate. This is my base case. Greenland plays both sides. Uncertainty reigns. Silver goes vertical because fear is a better driver of price than greed. Here is the verdict. The era of silver as a precious metal is over. We have entered the era of silver as a weapon of war. If you are holding paper contracts on the COMEX, good luck. They will settle you in cash when the vaults run dry. If you are holding physical, do not sell. Not at $95, not at $100. The real price is being set in the frozen dark of the Arctic, and the bid is $137. We are witnessing a liquidity squeeze that makes the 2008 crisis look like a picnic. The smart money is positioning for a world where the paper price is irrelevant. This is the beginning of the Arctic resource war. I'm long in physical. I'm a long miners, and I'm watching page 47. Smash that like button if you're paying attention. Subscribe because the mainstream media will not tell you this.
December 22, 2025. While the world was distracted by holiday lights, a silent detonation rocked the global markets. Spot silver shredded every technical resistance like tissue paper, hitting a staggering all-time high of $69.53 per ounce. Why now? Why has the poor man's gold surged 130% in a single year, leaving gold's 60% gain in the dust? This isn't just a rally, it's the short squeeze of millennial proportions. While the masses chased volatile shitcoins, the smart money was quietly siphoning physical inventory out of COMEX and LBMA vaults, creating a lethal liquidity vacuum. The paper silver market is about to face a brutal reality. There is no physical metal left to back their leveraged bets. If you think $70 is the ceiling, you're misreading the tape. This is the death knell for the big shorts and a calculated trap for the arrogant. The spring is coiled. The trigger has been pulled. Welcome to the silver endgame. Follow the trail of breadcrumbs into the dark heart of the global financial plumbing. My investigation reveals a three-pronged pincer movement designed by the smart money to crush the shorts and corner a market that is fundamentally broken. We are not just looking at a price rally, we are looking at the controlled demolition of the paper-silver illusion. 1. The debasement of the fiat shield. First, we must look at the Federal Reserve's systematic betrayal of the US dollar. Jerome Powell has effectively waved the white flag in the war against inflation by slashing the federal funds rate to the 3.5 to 3.75% corridor and stealthily reigniting the quantitative easing furnace. The Fed has signaled that the dollar is no longer a store of value, it is a depreciating liability. With the DXY dollar index bleeding out to a low of 98.6, the global elite are rotating their wealth out of digital promises and into the only conductor that matters. When fiat dies, Bach, silver, is the resurrection. 2. The industrial death trap, AI and the net zero facade. While the media distracts you with political theater, a structural supply-demand vortex is swallowing every available ounce of silver on the planet. This isn't just about jewelry, it's about the blood of the fourth industrial revolution. 59% of global silver supply is now locked in industrial applications. Consider this. Each solar panel is a silver-hungry beast, consuming approximately 20 grams per unit. As the world blindly rushes toward the net zero mandate, they have inadvertently created a commodity trap. Couple this with the explosive growth of AI data centers and 5G infrastructure, both of which rely on silver's unparalleled conductivity, and you have a recipe for a structural deficit. We are currently entering the fifth consecutive year of a supply shortfall, with a cumulative deficit nearing 800 million ounces. The mines in Mexico and Peru are screaming for mercy, yet the world's appetite for AI and green energy is insatiable. 3. The ghost vaults of London and COMEX. The most damning evidence, however, lies in the vaults. My forensic analysis of the London Bullion Association reveals a chilling reality. Silver inventories have evaporated by 40% since 2022. We are seeing reports of institutional titans desperately chartering private cargo jets to airlift physical bullion across the Atlantic just to meet delivery obligations and avoid a technical default. In Shanghai, stocks have hit a 10-year nadir, and the COMEX registered inventory has plummeted to a mere 138 million ounces. The global buffer for industrial consumption has shrunk to a terrifying 30 to 45 days. The big banks have spent decades suppressing the price of silver through massive naked short positions on the COMEX, but you cannot print physical atoms. The iceberg orders are now surfacing. The whales are no longer buying paper, they are taking delivery. And when the vaults finally run dry, the big shorts won't just lose money, they will be incinerated. You are witnessing the greatest wealth transfer in history, hidden in plain sight. Connect the dots. The naval skirmish in Venezuela isn't just news, it's an opening gambit in the Great Resource War. By neutralizing 30 vessels, the U.S. is performing a surgical amputation of resource liquidity. Along with the Israel-Iran shadow war, these are systemic shocks designed to shatter global supply chains. In high-stakes finance, instability is the ultimate alpha. When the map burns, silver becomes the ultimate safe haven buffer. But here is the secret. Unlike gold's ocean of liquidity, the silver market is a tiny pond, a mere rounding error compared to the $100 trillion bond market. Imagine a fire hose of scared capital fleeing bonds and trying to squeeze into a teacup. That is silver, a coiled spring of decade-long suppression meeting a geopolitical spark. Now, consider the net zero paradox. By mandating green energy, governments unwittingly signed an irrevocable contract to buy silver at any price. While central banks claim to fight inflation, their industrial policies for solar, EV, and AI drive silver demand into a structural supercycle. They have trapped themselves as involuntary buyers of last resort. They are desperate. They need silver for their green utopia in AI state, but atoms are scarce. Their failing strategy? Print more fiat to subsidize demand, devalue the currency, and inadvertently propel silver prices higher. This is a feedback loop of systemic failure. We don't trade the news, we trade the inevitability of the collapse. The establishment bets on their narrative, we bet on the laws of physics in the scarcity of atoms. The spring is no longer just coiled, it is fracturing the casing. Are you positioned for the release? Don't let $70 scare you. To an investigator, price is just a distraction. Value is what matters. In 1980, silver hit $50. Adjusted for 2025 inflation, that peak is actually $200 an ounce. We aren't in a bubble. We are just beginning to correct a decade of suppression. Unlike the Hunt Brothers game in 1980 or the QE2 spike in 2011, 2025 is the perfect storm. It is the convergence of a real physical deficit, the AI industrial revolution, and the terminal debasement of the dollar. You can't print physical atoms to fix this. The final warning, the margin trap. The establishment is fighting back. Exchanges in Shanghai and New York, COMEX, are already raising margin requirements. This is a margin trap, a calculated move to force retail traders using high leverage to panic sell. They want your silver at a discount. Do not give it to them. The execution plan. Weaponize patience. The market is overbought. Don't chase the peak. Wait for the margin shakeout to pull prices back to the 60 to 65 zone. That is where the smart money has set their iceberg orders. Exercise leverage. Silver is high velocity. A 20% intraday swing is normal. Forget 10x leverage. Hold the asset, not the debt. The big picture vision. Ignore the $75 lowball targets from big banks. They are pacifiers. When a structural deficit meets a currency collapse, there is no ceiling. The veil is torn. Silver is the digital crude of the AI era. The whales are in position, and the spring is compressed to its limit. Will you be crushed with the crowd, or will you follow the smart money? The hunt is on. The war is just begun. Feast your eyes on the artificial opulence of Wall Street. If you only look at the flashing green on the ticker tapes, you'd swear we've entered a new golden age. U.S. stock indices are smashing through all-time highs, fueled by an insatiable AI frenzy. The masses out there are hypnotized. They believe that silicon chips and black box algorithms are the keys to an era of infinite prosperity. But look closer. That's just a polished veneer on a ship with a gaping hole in its hull. Step with me into the vacuum zone behind that velvet curtain. Do you even know what actually happened on October 23, 2025? While the world was distracted, obsessed with the launch of ChatGPT 6 and the latest metaverse vaporware, U.S. national debt silently breached the $38 trillion mark, a staggering, grotesque figure, an albatross of $500,000 hanging around the neck of every single American under the age of 18. Here lies the paradox. Why, in an economy heralded as the strongest in history, did the U.S. government face a paralyzing, months-long shutdown at the end of 2025? Why, while the Fed has pinned interest rates at record highs to suffocate inflation, has the price of gold refused to collapse? According to every textbook rule, high interest rates are supposed to be lethal poison for non-yielding assets like gold. But reality has just dealt a death blow to that theory. Gold has marched relentlessly toward the $4,500 threshold, while silver, often dismissed as the poor man's gold, has shattered every law of financial physics to strike $70. The answer to this madness cannot be found in Washington, nor in the hollow, rehearsed speeches of the Fed. It lies in an iron hand silently pulling the firewood from beneath the cauldron in the East. While the retail crowd is being lulled to sleep by phantom GDP growth numbers, the smart money is hearing the bone-chilling cracks in the foundation of the system. China is executing a maneuver they haven't dared to attempt in 2 decades. They aren't just quietly dumping U.S. debt to record lows, below $690 billion. They are fortifying a secret gold fortress. Internal investigative reports and forensic analysis of global flows suggest the truth is far darker. Beijing's actual gold reserves aren't the 2,300 tons they officially claim. Our data indicates it has likely surged past 5,000 tons. They're preparing for a net zero scenario for the US dollar. This is no longer a forecast. This is an investigation into the collapse of an old world order and the violent birth of a monetary system anchored in hard assets. Are you holding paper promises, or do you own the truth? Follow the money. Trace the flow to see the truth. According to the latest data we've unmasked from the U.S. Treasury, China has slashed its holdings of U.S. Treasuries to below $690 billion, the lowest level since the 2008 financial crisis. Remember, they once held over $1.3 trillion. They are dumping, but it's not because they lack liquidity. The actions of the People's Bank of China, PBOC, represent a global forensic analysis campaign. They have purchased gold for 13 consecutive months, but that is just the surface figure. Our deep cover sources indicate that China is constructing a gold fortress with actual reserves potentially exceeding 5,000 tons, double the officially reported figures. Why do they need so much gold? Because they recognize that U.S. debt is a necrotic wound. When debt exceeds the ability to repay, the U.S. has only 2 choices: print money to trigger hyperinflation, burning the currency's value, or default. Both scenarios lead to a single inevitable conclusion: the reign of hard assets. Meanwhile, Japan, the storm petrel of the U.S. alliance, is starting to disintegrate. The collapse of the yen, despite rising rates, is merely the first domino. Tokyo is being forced to choose: save its currency by dumping U.S. treasuries, or go down with the USD ship. When Japan offloads and China delivers the follow-up punch by liquidating their remaining $690 billion, the ice wall of the U.S. credit system will melt in hours. Now is the time to connect the dots that the mainstream media is too terrified to mention. Have you ever wondered why silver has skyrocketed over 140% in the past year? Why is silver outrunning gold? This is the logical leap you must understand. Silver is not just currency. It is the blood of green technology in defense. China dominates the global supply chain for solar panels and electric vehicles, the 2 most silver-hungry industries on Earth. By controlling the physical supply of silver while simultaneously dumping U.S. debt, Beijing is executing a masterclass liquidity squeeze. They are draining silver from U.S. COMEX vaults and shipping it to the Shanghai Gold Exchange. When the U.S. realizes they no longer have enough silver to manufacture missiles or solar grids, they will be forced to buy it back at extortionate prices using the very dollars that are losing value. This is a war without a single shot fired. They, the U.S., are trying to maintain their status by printing promises. We, China, and smart central banks are silently migrating to a system settled in gold and silver. The physical silver shortage is unavoidable. When gold and silver ETFs realize that the metal in the vaults cannot meet the demand for physical settlement, we will witness a technical default on paper exchanges. That is the moment gold won't just hit $4,500, it will aim for $5,000 in 2026. Investors, we are standing at the climax of a financial drama decades in the making. The spring of U.S. national debt has been compressed to its breaking point. At $38 trillion, every Fed rate hike is like a knife wound to the heart of the Treasury. China has spotted this jugular vein. They are waiting for the perfect moment, a black swan, be it a new geopolitical conflict or a banking collapse in Japan, to deliver the final blow to the US dollar. When this spring uncoils, capital will flee from anything labeled as a paper asset. Stocks may still rise in nominal terms, but their purchasing power will be pulverized by runaway inflation. Only those holding God's money, gold and silver, will remain standing amidst the rubble. The final warning: do not sell early. Do not let the short-term turbulence created by whales shake you out of your position. $4,500 gold and $70 silver are just the warm-up act. 2025 is the year of the crash. 2026 will be the year the world reprices everything. Remember, they want you to believe in the numbers on your screen. We believe in what we can hold in our hands. If you want to continue following the deepest, rawest investigations into the flow of money, hit subscribe to receive the earliest alerts from us. Tonight, I am delivering an exclusive investigation into a systemic collapse, or a life-changing opportunity, depending on which side of the barricade you stand. We are on the precipice of an event I call the liquidity massacre. While the world sleeps, a trap has been set by the smart money, and tomorrow the jaws begin to close. This is not just a market report. This is a forensic analysis of the disappearance of trust and the violent return of physical reality. Tomorrow morning, December 26th, the world will wake up to leftover turkey and post-Christmas sales. But in the shadows of the global commodity markets, a black hole of liquidity is forming. While the big institutional traders at the desks in London, New York, and Singapore are skiing in Aspen or lounging in the tropics, the silver market, the very nervous system of modern technology, enters what we veterans call the ghost week. Look at this terrifying paradox. Silver just closed at $71.94 per ounce. That is a staggering 149% gain in a single year. Any sane observer would expect a correction, but instead of a retreat, we see an eerie silence. Trading volume has evaporated by 70%, yet 145,000 futures contracts are still hanging in the air like unexploded ordnances. The crowd thinks the market is resting. They are wrong. The market never sleeps. It only becomes empty. And in the world of high-stakes finance, a vacuum is never stable. It is filled with violence. A liquidity vortex is swirling, and the most critical factor, the one no one in the mainstream media is telling you, is that while the West is asleep at the wheel, a gargantuan force from the East has already pulled the pin on this grenade. If you follow the money, it leads to a chilling realization. Those 145,000 contracts on the COMEX aren't just digital blips. They represent 725 million ounces of silver. To put that in perspective, that is nearly the entire annual mining production of the planet. Who holds these positions? And why did UBS, one of the most powerful banking entities on Earth, casually use the word unhinged to describe this price action? The answer lies in the massive premium gap between New York and Shanghai. While retail investors in the West are distracted by green and red candles on their phone apps, the Shanghai Gold Exchange is trading silver at a premium of over $5 per ounce higher than the global spot price. This is a massive industrial vacuum. China isn't just buying silver, they are running an industrial-scale suction machine, draining every available ounce of physical metal from Western vaults in London and New York. My investigation shows that silver inventories in Shanghai have plunged to 10-year lows. Why do they need this much metal right now? Because they know something you don't. On January 1st, Beijing is prepared to implement drastic export controls on silver. An ice wall is about to be built, cutting off the flow of silver from the world's largest factory. When the thin liquidity of Ghost Week hits the brick wall of a Chinese export ban, we don't get a standard price adjustment, we get a liquidity extinction event. Why now? Why this sudden urgency? Look at the technology. The global solar industry has shifted to TOPCon cells. These aren't your grandfather's solar panels. TOPCon requires 50% more silver paste per unit to achieve its efficiency. China controls 80% of this supply chain. They aren't just players, they own the casino. By hoarding physical silver and then cutting off exports, China is effectively taxing every Western tech company. If Tesla, Apple, or Samsung need silver for their 2026 production lines, they will have to beg for it, and they won't be paying $72. The US government has seen this coming. That is why silver was recently designated a strategic critical mineral. This is the opening act of a metal war. We have seen silver deficits for 7 consecutive years, a cumulative shortfall of 678 million ounces. We've been living on borrowed silver, draining the ETFs and the old stockpiles to fill the gap. But those stockpiles are gone. The paper silver market, which trades 100 ounces for every 1 ounce of physical metal that actually exists, is about to hit the wall of reality. In a market with 145,000 contracts and no physical metal to back them up, the price becomes irrelevant. The only thing that matters is delivery. And with China locking its gates on January 1st, the Western banks are caught in a pincer move between record industrial demand and a total supply blackout. Now, let's run the math for January 2nd. The holidays are over. Fund managers return to their desks in Manhattan, nursing hangovers and looking at their screens. They see the news. China has restricted exports. The Shanghai premium has exploded to $10. The 145,000 contracts on the COMEX are suddenly a liability of $52 billion. Every short seller, every bank that sold silver they didn't have receives a notification, the margin call. Because there is no liquidity during the ghost week, the price doesn't climb, it teleports. The resistance at $75 will be vaporized. The smart money knows that $80 is the psychological breaking point. An $8 move from our current level is not a guess. It is a mathematical certainty when forced buying meets a physical drought. In a short squeeze, the price stops when the last seller is liquidated. But who is the seller if China has closed its doors, if the vaults in London are empty? The price runs until the industrial giants, the ones who must have the metal to survive, simply outbid everyone else. This is the feedback loop of the elite. It's not manipulation, it's the structure of a broken system finally collapsing.
The ghost week begins tomorrow. By the time you watch this, the trap has likely already sprung. The 145,000 contracts are frozen. The Shanghai vacuum has done its work. The ice wall is being built as we speak. My advice? Do not be the liquidity for the big banks. Do not sell into the first spike. They want your physical metal. They need your shares in the miners to cover their billion-dollar blunders. When the world asks on January 2nd how silver gapped from $72 to $80 overnight, you will know the answer. It was a forensic certainty, hidden in plain sight, driven by a global struggle for the most important metal of the 21st century. This is the moment where paper meets metal. The $8 squeeze is just the beginning of a repricing that will define the next decade. Stay disciplined, stay skeptical, and above all, watch the vaults. Because in this market, if you can't touch it, you don't own it. I will see you on the other side of $80.